Hello everyone. I hope you are doing well and taking care of yourselves. Today we are going to discuss a very interesting topic, that is mutual funds versus exchange traded funds. So without any further ado, let's begin, shall we? Mutual funds and exchange traded funds are similar financial instruments that have plenty in common. Both the instruments invest in a portfolio of assets that may consist of a combination of stocks, commodities, bonds, money market instruments, etc., and represent a common way for the investors to diversify. Despite their similarities, they do have subtle differences in the way they are managed. So before dwelling into the differences, let's first understand what mutual funds and exchange traded funds are. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers or fund managers who allocate the funds' assets and attempt to produce capital gains or income for the fund's investors. On the other hand, an exchange traded fund, or ETF for short, is a type of security that tracks an index, sector, commodity, or other asset, but which can be purchased or sold on a stock exchange, the same as a regular stock. An ETF can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities. So now you probably might be wondering that these two financial vehicles sound pretty similar. Then what is the difference? Right, so let's go over a few points of differences. The first being investment requirement. Typically, mutual funds have a higher investment requirement compared to ETFs. This is mainly because mutual funds are actively managed by fund managers or money managers, and therefore they have higher fees and higher expense ratios as compared to ETFs, which are passively managed. Second, management. As mentioned in the previous point, mutual funds are actively managed by the fund managers. They buy and sell assets in order to beat the market and help their investors profit. ETFs, on the other hand, are passively managed instruments. They just simply track an index or a commodity. Third, lock-in period. ETFs do not have a minimum lock-in period and can be sold whenever the investor wishes to. Mutual fund schemes can have 9 days to 3 years of lock-in periods depending on the scheme chosen. Fourth, flexibility. One of the main differences between mutual funds and ETFs is that ETFs can be traded multiple times in a day, similar to a stock. Hence, ETFs are very flexible. Fifth, types. Broadly speaking, there are two types of mutual fund schemes: open-ended funds and close-ended funds. According to SEBI, an open-ended fund or scheme is one that is available for repurchase and subscription on a continuous basis. The investors can conveniently buy and sell units at net asset value related prices that are declared on a daily basis. According to SEBI, a close-ended fund or scheme is one that is open for subscription only during a specified period at the time of the launch of the scheme. ETFs can be broadly divided into 4 types: gold ETFs, equity ETFs, debt ETFs, and currency ETFs. In gold ETFs, the fund deals in commodity exchanges. After investing in this fund, the investor becomes owner of gold on paper. In equity ETFs, the fund invests in equity instruments. In debt ETFs, the fund consists of debt funds such as commercial papers or debentures. In currency ETFs, the fund invests in foreign currencies and gains profit from the fluctuation in their values. Mutual fund investment or ETF investment. You see, both of these instruments shine in certain situations. Both these instruments are an excellent way through which the investor can create a diversified portfolio. First, liquidity. ETFs will be an investor's best bet if they are looking for a high liquidity investment. Remember how we discussed that ETFs can be traded multiple times and whenever the investor wishes, as opposed to mutual funds that had a lock-in period. Second, risk appetite. If the investor has a medium to high risk appetite, then mutual funds will be the suitable investment. However, if the investor does not want to take any risk and just wants safe returns, then ETFs will be more suitable. Third, investment horizon. For short-term investment horizon, an investor should choose ETFs, whereas for medium to long-term investment horizon, mutual funds are the way to go. Fourth, your tax saving strategy. Mutual funds have more tax liabilities than ETFs. However, ETFs offer tax benefits to investors due to the manner in which they are created and redeemed. So that's it, guys. I really hope this video cleared whatever doubts you had regarding mutual funds and ETFs. If you have any further doubts, be sure to leave it in the comment section and we will get back to you. If you like this video, do not forget to like, share and subscribe to Money Making Trading Courses by Tushar Gone. Thank you.